I really hope this is going to be short and straightforward. Investment decisions, and we're only looking at part 1 today. So if you're just joining us for the first time, you need to go and have a look at the previous video on the financing decisions. So what I said earlier was basically, as a financial manager, the two things that you are going to be engaged in is financing decisions and the investment decisions. So I sent the notes for financing decisions earlier, right? I sent those notes earlier, and I think if there's anything that's omitted on those notes, it's probably something that we are covering on the question papers as we are moving forward. All right. But at the end of the day, after you've collected the finances from the so-called funders, of which we dealt with that in the previous session, and you've looked at the cost of the different financing options that are available in the market, you must then use that finance for the investment decision. So usually the starting point would be for you in identifying the decisions, sorry, in identifying the investment opportunities that are there, and then you can go on to search for the finances, right, that can be able to fulfill that. So remember, the rule was, in terms of finances, you want to go for the one that's got the lowest cost. But there are many other things that you take into consideration. I think that's normally discussed in the question papers. You get such questions, that what other factors can you take into consideration besides the calculations? So calculations merely give you the different costs of those finances, right? But what other factors can you look at, right? Then we'll tackle that again some other time. But in terms of investment decisions, we are looking at the basics today, the basics, and then on the following session, we'll be moving on from there. So after we are done with this, then we'll tackle a question. And if you've got access to assignment 2 for MAC 3702, if you've got access to that assignment 2, please post it in the group. I will repost it in the other group. Maybe it might have questions that deal with what we are dealing with now, right? But we will first of all define some key concepts, right? So these key concepts are crucial, especially when you are dealing with theory questions, right? Theory questions. And of course, it helps you have a general understanding of what investment decisions entail, right? So the first one is going to be independent project. So we are dealing with investment decisions, and you're obviously going to be deciding what projects the organization needs to get into or need to be engaged in. All right. So independent projects. So in the context of capital budgeting, so we are doing, this is all under capital budgeting, and capital budgeting, by the way, is basically looking at the long-term investments, right, and deciding which one is best. So we are basically budgeting, right, or doing an appraisal. So it's normally called capital appraisal or capital budgeting, whichever one you want to go for. Right. So we refer to investment opportunities where the cash flows of one project are not affected by the acceptance or rejection of other projects. So this is independent projects, right? So it's where the cash flows of one project are not going to be affected by the acceptance or the rejection of other projects. So in other words, cash flows of independent projects are unrelated to each other. Therefore, the decision to invest in one project does not influence the decision to invest in another, right? So these projects are basically independent of each other, right? So when evaluating independent projects, each project is assessed on its own merits. So regardless of whatever project you take, it's not going to be affected by that. So we use the net present value, internal rate of return, payback period, and the likes. Right? We are going to be dealing with those much later. All right, and then what about mutually exclusive projects? So again, still in the same context, this is a situation where a company must choose between two or more investment opportunities because they serve the same purpose or address the same need, right? So in other words, if one project is accepted, it means the other project cannot be undertaken, right? So you are taking that or that, right? So in terms of independent projects, they just don't affect each other. But mutually exclusive projects, you can't have them at the same time, right? Something that's mutually exclusive, it's male and female, right? So you are either male or female, as far as I know. That's an example of mutually exclusive. So you either take that or you take the other. So that's an example there of a mutually exclusive project. So when evaluating these projects, companies need to compare the potential returns and benefits of each project to determine which ones should be accepted. We should rather say which one should be accepted based on the financial strategy and objectives. So some of the key consideration, investment criteria. So companies typically use investment criteria such as the NPV, IRR, the payback period. So obviously the project with the highest NPV is or the most favorable IRR, the shortest payback period, must be considered as the best choice. So you want to go for that one, right? And then, of course, you look at the resource constraints. The company needs to assess their available resources, including the financial resources, manpower, technology, and material. So for the most part, financial resources will be dealt with or were dealt with in the previous chapter, right? So that covers normally the financial constraints there. How much money can you get and how much does the project want? But other factors that you take into consideration are the manpower, right? What type of manpower is required by this project, or the technology or the materials, how available is it? So remember what we are doing here, we are basically choosing between competing projects, right? So under the last one here, mutually exclusive, you can only take one. You can't run them all at the same time. But with independent projects, they are not affected. So if your money allows, then you can have them running at the same time. So that is if you don't have any of these other constraints that are limiting you. And then, of course, strategic alignment. So this is the non-financial aspects that you must consider when deciding whether or not to take a project, right? So the project should align with the company's long-term strategic goals. So at the end of the day, the fact that a project is making a profit does not necessarily mean you should go for that project. Right? It must align again with the whole strategy, long-term strategy of the company. You must make sure that it aligns. Okay, and then risk assessment. Oops, sorry about that. Risk assessment, the company should consider risk associated with each project, right, including analyzing the potential challenges, uncertainties, market factors that could impact on a project's success. So all that there, this is the other non-financial things that you consider. So which means what we do here in financial management for starters is to run the calculations, right? You run the calculations and see whether the project is going to be profitable or not, if it's going to increase the value or contribute to the value of the organization. And then other than that, or over and above that, you then look at these other factors here, which are being described. Market demand, of course, projects should be evaluated in the context of market demand and customer preferences. So sometimes you might do your calculation, things seem good, but if a project, if you can project in the long run that customer preferences are going to move in contrary direction, there is no need for you as an organization to invest heavy machinery into a project that's going to die in just a few years. Synergy with existing operations. So companies should consider whether a chosen project complements or enhances their existing operations. So projects that leverage the company's strengths or capabilities should be preferred. Right. So that's a lot of points there to consider in terms of non-financial or non-quantitative or just qualitative factors that you can take into consideration there. All right. And then again, divisible projects. What are divisible projects? So divisible projects are projects where the whole project or any fraction thereof may be initiated. So basically, divisible, you can divide it, right? It's like our module now. We are dividing it week by week. So it's a project right? We are engaged in a project, but again, it's a project that can be divided. So it's a divisible project. Some instances, it can be indivisible, right? So these are projects where a whole project must be undertaken in its entirety and not at all, or not at all. So you either take it or you don't take it. You can't start it and leave it, right? You can't do it. You can't break it down or scale it down or scale it up. You basically can't do that. So it can't be divided into biteable portions. That's an indivisible project. And then with capital rationing, we are referring to a situation when enterprise is unable to initiate all available, apparently viable projects because of limited funds. This is normally the case, right? This is normally the case. Unless maybe if you run the reserve bank or something, you've got access to unlimited funds, then this will apply, right? And then single period capital rationing only applies in a single period, and then multiple or multi-period capital rationing is a shortage that is expected to extend over a number of periods, right? So again, you've got access to these notes. I posted them in the group. So during your spare time, you can just go through that, okay? And then traditional methods of investment appraisal. So now we are looking at the quantitative methods, right? Quantitative methods, which is anything quantitative is numbers. I'm sure if you have arrived at this stage, you must have a high tolerance of numbers, because you must have gone through MAC 2602, which has numbers. You must have gone through your maths modules, which has a lot of numbers. So you have a high tolerance for numbers. So the first one and the simplest one is going to be your payback period. Besides knowing how to calculate the payback period, you need to know the theory of the payback period. So which is going to include the advantages and the disadvantages. Sometimes the question can ask you, to what extent can you rely on this method, or how appropriate is this method that you want to use in evaluating a project, right? So remember, the context here is you have a project, or not just a project, there are a number of competing projects. For the most part, there's going to be a number of competing projects that you need to choose, right? That you need to choose as an organization. So you have the money, but you can't just spend the money the way you want to spend it, right? Or you can't just, use your emotions in spending company money. You need to do your calculations and do your analysis and decide the best course of action. All right, so the payback period is a simple capital budgeting method used to evaluate the time it takes for an investment to generate enough cash flows to recover its initial cost, right? So how long it takes for a project to pay back the initial amount or the initial cost to recover that initial amount. That's what we are trying to calculate there. So the payback period is expressed in terms of the number of years or the number of months. What are the advantages of the payback period? It's very simple. That's advantage number one. Number two, liquidity and risk. It provides a sense of how quickly an investment will generate cash flows, which can be useful in assessing the liquidity and risk. So a shorter payback period implies faster cash flow recovery and potentially lower risk, right? You don't want to have a project that's only going to recover its money or its initial outflow or outlay after 100 years. A lot of things can happen, right, between now and the next 100 years. You always prefer it to be shorter. And then again, it focuses on the initial investment recovery, right? So which can be important for projects with high uncertainty and rapidly changing technological environments. So if you're going to invest in say the tech industry, if you're going to be in the tech industry, then you want to have a project that can have as short as possible a payback period, right? Because suppose you are dealing with phones, right? Once you've got a new phone in the market, give or take 6 months down the line, your competitors have got a similar phone. So you should have at least made your recovery really quickly, right? What are the drawbacks of the payback period? Time value of money is ignored, right? So the payback period does not account for the time value of money, as we are going to see. I think I've got an example ready for us to deal with there, right? And then incomplete analysis, it ignores cash flows beyond the payback period, leading to an incomplete analysis of the investment's long-term profitability, right? So we only deal with how soon we can get back the initial funds. Once we've gotten back the initial funds, we basically ignore everything there. And then there is no consideration for profitability. We are simply dealing with cash, right? So investment with short payback period might not be the most profitable one. All right. Doesn't consider cash flow timings again. So the method doesn't differentiate between investments with different cash flow patterns. So two investments with the same payback period could have different cash flow distributions, right? That's possible, right? And then it ignores the discount rate. So the discount rate is also catered for here on the time value of money. We basically make use of the discount rate. All right. So before we make corrections on the payback period, let's see if we can run an example on that. A very simple example. I hope this is the one. Okay, this is not it. We want maybe this one here. All right. This was adopted from, what's this college? I think I got this last semester from Regent. Right. It's very simple. It's very simple. A lot simpler than what we would get here. All right. So as a financial manager of ALM Limited, you are required to analyze the two proposed capital investments, which is N and O. And then the project's expected net profits or net losses are given as follows. So you have your project N and your project O, and then you've got your given cash flows there, right? And then the cost of capital for each project is 12%. Don't sorry about that. Sorry about that interruption. You see, people start calling me when I'm in class. Okay. All right. Sorry about that. There was a crisis today. I think most of the day the UNISA system was down. So I'm sure people are calling to let me know that the system is back online. All right. So I'm just gonna put this up on an Excel sheet. Right. I'm just gonna put this up on an Excel sheet. So we've got here. I will take you there shortly. I'm just writing here on the side while I've got our page open. So we've got here 1, 2, 3, and 4. All right, and then we have project N, and then we have project O. Right. You are reminded again that if you have any questions, you can always stop me anytime and ask. All right, so we had 40,000, and then we had 5,000. So these are profits. And then we had 5,000, and then we had minus 15,000. So I'm taking this from project N, and then for project O, 10,000 right through. All right, so I'm just going to be doing a demonstration of how we go about with this one. So take note here on the question, the amounts that are given here are expected net profits, right? And net losses for that one there. And then when we are dealing with the payback period, we are dealing with cash flow. So the first thing to do is to make adjustments on that. So how do we go about that? So the only thing that's given there, the only adjustment that we can make there is that 25,000, which is depreciation. All right, so I'm gonna talk about that shortly, but let me share what I've been writing there. All right, okay, there you go. So this is what I've been writing. So all this information is what you could see there. So you have your project N and project O. You want to analyze this using payback period, right? So I'm gonna make a space here. I'm gonna make some space on that one, right? And then on year 0 here, I'm gonna put the initial outlay, so which is the money that was initially pumped into the project. So we are told it's 100,000 from the question. So I'm just gonna put that there as 100,000, 1, 2, 3, and then. So this is simple and interesting. You could even do this with your own projects there. See how good your project is gonna do. All right, there we go. This is what we have there. All right, so like I said, this 100,000 is cash, that 100,000 is cash, but all these are profits. And then we are told that to arrive at those profits, obviously depreciation had to be deducted from that amount, and the depreciation was estimated to 25,000 a year. So how do I make that adjustment? Then we can simply go on to add 25,000 every year. Okay. We can simply add 25,000 every year. So when dealing with these questions, check very carefully to see if what you are given is cash flows or is profit. Profit is an accounting thing, right? It's basically an accounting concept, and it caters for non-cash items like depreciation. There could be some others. There could be some other non-cash items included there, but the most classic example would be your depreciation. So you wanna check that out there. So that one is the same. So there we go. We've adjusted all these amounts there we've adjusted our amounts for non-cash items. Right. So the first thing to do now is to see how long it takes for this project to buy itself, right? Or to pay for itself, right? So the initial amount that was put there, okay, we can put that there as balance, right? And that one is balance. So you can find a better way to present this, all good. Right? It would be nice to find a better way to present this, but I find this to be the easiest way to present this one. So on the first year, so we are going to make 65,000 on the first year. So we're gonna take that amount and then we add our 65,000 there. So we remain with 35,000. So we basically have 35,000 outstanding there. And then next up, we've got 35,000, and then we add 30,000 more of that amount. What do we get? We basically get back, we basically remain with an outstanding of 5,000. Right? And then next up there, we've got 30,000. So which means obviously this amount is going to be covered by that. Right? So we can just put that up there that way. So which means for that project there, it's basically going to take how many years? 3 years for starters, right? For us to get to a point where at this point, all right, at this point, we are basically at a point where we are basically at a point where the project has bought itself after 3 years. But then you notice now that after 3 years, we have actually overlapped, right? If you notice that we have overlapped and we've actually gotten to actually gotten where to, we've actually gotten to 25,000, which is way ahead of the 5,000 that we needed. Right. So the best way now in which you can analyze this, it's obviously gonna be at that point there at year 2 and a couple of months into year 3. That's the point where that's the payback period, right? That's gonna be our payback period there. All right. So I think my other machine just got kicked out there. Right. My other machine just got kicked out there. I'm just waiting for it to jump back in. All right. This network is messing me up. Right. All right. Sorry about that. I'm just reshifting there. All right. All right. I'm back in. Let me just share. Right. Let me just share. You should be able to see the screen. Right. We are back online. So I was still saying, so when you get to now, you realize that we get a positive where on year number 3, then this is where we are getting our positive. So which means for our project to by itself, to basically get the funds that can recover the initial amount, it's on year 2 and a couple of months or a couple of days or weeks into year 3, which is what we want to find out now. All right, so I'm gonna put it this way. So we are gonna say number of years there, right? So we can see it's gonna be 2 years there. So what was outstanding now? So which means it's year 2, we only have 5,000 outstanding, and then into year 3 we are getting 30,000. So we don't need all that 30,000 there. We only need 5,000 out of that 30,000. So which means you are gonna divide your 5,000, which is what you need there, which is what is outstanding. You divide your 5,000 by your 30,000 there, and then you want to multiply that by, say, 12 months, right? If you want to get it in terms of your months there. Right. So let's say this is our project N. Right. We take that there and put there as our project N. So which means we can bring that down. It's gonna be 2 years. And so how you present this is basically up to you. So here I'm just trying to show you how it works. So it's gonna be 5,000 divided by 30,000 times 12 months, or yeah, makes more sense for you to use 12 months there. So that's basically gonna give us what? 2 months. So which means project N's payback period is 2 years and 2 months. Very simple, isn't it? So let's see what happens now on project O. So on project O, we get 100,000 outstanding there, and then we get 35,000, remain with 65, and then again we take that 65, we are getting back 35,000, 30,000 left. Then if you assess now, we are back at that story. We are back at that issue now, where if you take that 30,000 and you add it there, we are going to jump into a positive there. We are going to be in excess by 5,000, right? So which means basically, in terms of years, we're going to stop at 2 years. And then what's outstanding after 2 years is 30,000, which needs to be collected on year number 3, right? So let's take that as project O there, which up there on project O. So 2 years again, but what's outstanding now is 30,000. So we basically need 30,000 there from year 3 out of a total of 35,000, which is available there on year 3. And then we are multiplying that by 12, right? So that's going to be 12 years, and 30 divided by 35 times 12, right? So that's basically 10 months, right? 2 years and 10 months and a couple of days. All right. So you can then run your assessment now. Ask yourself which project has the shorter payback period and which one has the longer payback period. So clearly, project N has got the shorter payback period. And then project O has got a slightly longer payback period. So it's only longer by 8 months. It's only longer by 8 months. So the tricky part on this one now is your assessment when you get to that part there. Right? Your assessment when you get to that part there. So the thing to do is you look at the years. Okay. Once you get to a point where now you can see that your cash flows are getting positive, like there and there, then you take the year that's behind, which is the prior year. So you take the 2 years and then you seek to calculate the months now. Then you basically try and calculate the months on the following year, which is year 3. So how do you go about that? You look at what is outstanding. So this is what you need, the amount that you need for you to totally recover that 100,000, that initial 100,000. So you take that 30,000 and you divide by the total in that year 3. So you need 30,000 from year 3 out of 35,000. So how many months will that take you? So you multiply that by 12. That's going to give you the number of months. Sometimes you're going to have to do this, per day and the likes, but basically it depends with the question. All right, let's move on from this now and we look at discounted payback period. We look at the discounted payback period. So I believe we are here. All right, I believe this is where we are. So because of some of the challenges that are experienced there on the payback period, we then do the discounted payback period. So when using the discounted payback period, one takes into consideration the time value of money. So if you remember, one of the disadvantages of the payback period is it did not take into consideration the time value of money. Right? What are the advantages of this discounted payback period? Obviously, one, it takes into consideration the time value of money. Right? Better analysis by accounting for time value of money. Discounted payback period provides a more complete analysis of the investment's profitability and value. Right? And then comparable to discounted cash flow method. So this one can be comparable to your NPV, your IRR. Right? What are the disadvantages? Slightly complex. And then subjectivity of this discount rate. Who decides which discount rate to use? Because the discount rate that you use has a very big impact. It has a very big impact on your cash flows, your discounted cash flows, and the value of your project at the end of the day. All right. And then incomplete analysis. While it accounts for the time value of money, the discounted payback period still ignores cash flows beyond the discounted payback period. And then it doesn't consider the profitability index, right? So next up, we'll be looking at the ones that might take into consideration that. But before we get to that one, then we are going to do the discounted payback period for the same projects, N and O. So we are basically running around on the same exam. All right, so what do we do now in terms of the discounted cashback period? Then we want to add a column on that. So let's take this out. Right, we want to take all this out there, and then over here we're going to have different answers. So by the way, how you write this portion here, which I just highlighted, which is your number of years, is entirely up to you. You just have to write it the way it's easy to understand. Oops, what's going on here? It's highlighting the wrong things. It's misbehaving, but in any case, we are almost done. Right, so we want to add a column here. And then, of course, if we add a column there, we are going to add another column there. Right. All right. Sorry, it's misbehaving here. Sorry about that. Right. Sorry about that. We are almost done. I've got some crazy network issues. Okay. So what I just did there was just adding columns there. Right. So that's the first column that I'm gonna add. So I'm gonna add two columns. So here you're gonna call it the discounting factor. Right. You're gonna call that one the discounting factor. So you're gonna take that and re-put it there again. Right. And then there you wanna have a discounted cash flow. So all this is out now because we're gonna run different calculations for that. Right. So these are the raw cash flows there. And then here we're gonna have the discounted cash flows. Right, discounted cash flows. Right, and then we want discounted cash flows there again. Right, so I'm gonna put all these here to be bold. All right. I think the network on the other device is a little bit slow. Let me adjust there a little bit because we are almost done. I want us to complete this by 8. Then you guys can be free on Monday. Right. I'm just waiting for an adjustment there. Right. I'm just waiting. Right, we are almost done. We are almost done. Just bear with me. I'm just re-adding this device. Okay, I think we have it here. It's all right. Sorry about that. The device is gonna join just now. Okay, it's in now. All right. Okay, sorry. I'm actually about to have plot checking, so this is why this thing is messing around now. That's why it's messing up. Right, so I think it should be better now. All right, there we go. So all that I was doing was adding these columns here. So the discounting factor, let me just check on the question. The discounting factor was 12%. So we are going to make use of that 12% there. Right, so how do we go about that? So the formula for, if you're not going to check the tables for this, and you're going to use a formula for the discounting factor. So it's 12%. The formula is basically 1 divided by 1 plus r to the power of n. That's what I just wrote there. So that's the formula that you use there to calculate your discounting factor. So you use that all the time. If you don't have access to tables, or you could just put that on the calculator, but it's a lot, if you're using Excel, it's a lot easier for you to have a formula there. All right, so this is going to be 1 divided by 1 divided by 1 plus, so the rate that is used there is 12%, so 0.12 to the power of the year, right? To the power of the year. So That's what we get. So on the first one, that's why even if you check on your tables, it's usually gonna be 1 there. So you want to repeat the same thing there. Okay, so it's not capturing the way I want it there. Okay, it is, but we need to, let me show you what it's gonna be. Right. So I've just repeated that calculation right through, so that's what you get there. Right. So let me put it to five numbers after the comma. So that's what you get. So this there is gonna be the same as that there. The discounting factor is just the same when you're analyzing for project. So we can copy that there. Right. All right. So remember, it's 1 divided by 1 plus the rate to the power of n. So n is the number of years. So it keeps changing there every year. So the reason why you saw 1 there is because it was rounded off. All right. So the discounted cash flows now, how do we get the discounted cash flows? You are basically multiplying the factor by the cash flow. Right? You are multiplying those there. So once you do the multiplication, that's what you get there. Right? And then you do the same for that one. It's the cash flow. Right? You're multiplying the cash flow by the discounting or the discounted factor. Right? Let's make those, okay, no, those don't have to be bold. All right. So now we are repeating what we did there, but only that we are using discounted cash flows, right? So you take your 100,000 and then you want to add cash flows for the first year, you get that, and then for the second year, so 41,964 is outstanding, then you go for the second year, you see it's 18,000 outstanding. So already you can see now we are at that point there, right, where it's going to get positive. Okay, so you basically take that way. All right, let's see what happens now on this one. It gets 2 years before it can get positive. So you can put your 2 there on years, and then on the months, right? On the months, we are doing the same calculation. So you take your 18,000 there, that amount, and then you are dividing that amount by the total for the next period, which is the period in question, right? And then you multiply that by 12. So that's going to give you, okay, so the reason why this is giving you a negative there is because, remember, I took that as it is there. So to eliminate that, you can simply put that there. So that's going to give you 10 months. That's what you need. And then we do again for the next project, which is our project O. All right. So you take your 100,000, right, and then you add for the first period, and then you do the same for the second period there, and then for the third period. Now it's getting lit. You see, so it's this one now is year 3, right? Now this one gets up to year 3, right? How many months? And then you basically take that there. So we've learned now to make it positive there. And then you are dividing that by that and multiplying by 12. So 3 years and 9 months. You see a huge difference now. Right? First time when you're using the normal payback period, we got something totally different from what we are getting now. So it was 2 months, so it was 2 years and a couple of months, but it's a lot similar again. It's only taking a lot more, except that project O has jumped into 3 months. So it's almost a year difference now. All right. So that's it on the payback period and discounted payback period. So next up, we are going to be looking at net present value and the IRR. Those are the ones that we are normally going to be examined on for much longer mark allocation.